drop a note to sales@motivewave.com, and Lee can probably set up a discount for you early.
Perfect, perfect. So we're actually going to have it up on our site very shortly. And have you guys released it yet on the site or not yet?
No, it's on the website.
Oh, there it is. Okay, perfect. Yep. So officially it begins Friday the 28th, but as Tony just said, if you want to get something a little earlier, it's sales at MotiveWave.
Yeah, that's correct.
Okay, perfect. So obviously, guys, the MotiveWave software is the best Elliott Wave software out there. So they do these sales very infrequently, so be sure to jump on board. And it's a one-time purchase, and you do have the ability for a very small sum to get all future upgrades for what is it, $100 to $200 a year. And Tony's constantly updating the software with new features, so be sure to check that out. We also offer a trading analysis edition, which is custom for some of the setups and the way we look at the market. So you can check that out. We'll talk about that, but should be a great sale. And obviously, we rely on MotiveWave software very heavily, so be sure to check it out. Anywhere you want to jump in, Tony, just let me know. But we'll dive in if you're ready.
Okay, I'm good.
Okay, cool. All right, guys, so let me just actually hit the recording here and get this going. Okay, perfect. All right, guys, so to start, we're coming up on a holiday period here in the U.S. And, my background as an FX trader, I can remember several Thanksgivings when the currency market actually went nuts. I'm talking 200-300 pip breakouts as soon as we sat down to Thanksgiving dinner, and we all had a couple glasses of vino or cerveza or whatever you're drinking, and I look at the phone and the euro's up 300 points. It doesn't happen all the time, but there's just a couple times out of the last 10 years that there's been a big move. So, there's been some big moves in the FX markets leading up to this. So, we'll see. We'll keep an eye on this. The dollar's in the middle of a pretty big rally. The commodity markets are in the middle of a pretty big sell-off. And something we're going to talk about today is the bond market is in the process of a move higher finally after a long period of consolidation. So it's important to understand what's going on in the intermarket perspective. Okay, so the bond market here in blue is beginning to move higher. And, I did a 4-hour presentation in Vegas last week about what a higher bond market may mean. And, there's a long-term chart that I would like to show you that actually demonstrates that, there is a relationship with the bond market that a lot of people don't fully expect. And I'll have to bring in kind of a screenshot of a chart. Tony, don't worry. This is a long historical chart. This is not a MotiveWave chart, but I don't have data through any of our brokers that goes back this far. But it's important to understand the relationship here of stocks and bonds. And when I asked the room, what they thought the historical relationship between stocks and bonds, all of them said stocks up, bonds down, stocks up. And I said, oh, really? If you look back to 1981, you can see that there's actually a direct correlation between stocks and bonds. Bonds kind of here in blue bottomed out in the final rally up to 2000 and then found a low and moved higher as the stock market sold off. Okay, so we can see the correlation actually dropped into the negative territory here. That was during the 2000 crash. So, then from 2003 to 2004 and 5.
Todd?
Yes, sir.
We're to interrupt. Can you just switch to your screen view? You're currently on your webcam.
Oh. Thanks for telling me. That's weird. Is that better?
Much better.
Okay, thanks. All right, so back to this chart. From 1981 up into the mid 90s when the bull market was going on, you saw stocks and bonds trading together. And then in 2000, when the S&P began to top off and then sell down, the bond market started to move higher, and that's when you saw the correlation drop below zero into a negative correlation. Then what happened is 2004 to 2006 and 7, when the real estate market was going crazy here in the U.S., the correlation started to move back to zero, away from negative territory. Then the credit crisis hit, and the S&P here in red sold off as bonds spiked. And then again, stocks and bonds went into negative correlation. But what's happened since is they've come back to a positive correlation on this chart. And again, this is a website that I have access to that has long-term data. You can look back, hundreds of years in terms of this data. But point is, stocks and bonds in healthy markets, in markets that are not deflationary markets like we saw in stock market crashes, actually trade together. So the point of all that is, this bond market moving higher, it's not necessarily a bad thing. A lot of people think stocks and bonds trade inversely. Yes, they do. They trade inversely when the stock market is crashing. Okay, but when the stock market's rallying and we're not in a deflationary environment, we're actually moving into hopefully an inflationary environment with central banks doing everything they're doing. It's okay to see bonds rallying with stocks. That's my whole point. So, it's interesting. We're starting to see crude really come off. I mean, crude oil is it just broke down another couple percent over the last 24 hours of trading. We're trading at 73, around 73 and a half there in WTI. I think we're going to get down into the 60s. And what we've seen is gold has made a little bit of a divergence from crude. So gold has been moving higher from about an 1150 support area, currently trading around 1200 as crude oil is moving down. So you have a little bit of divergence. And the dollar doesn't quite know what to do with that. If you look at it, looks to be actually trading inversely to the crude oil market, and that's at CL, right? So we look to be just kind of eyeballing this. Dollar's been moving higher, as crude has been moving lower. Gold, not bad. I mean, also an inverse relationship to the dollar, but this last little bit of divergence here, gold's starting to top out, and the dollar's begun to sell off a touch. So we're starting to get a little sloppy in here, is my point. And then between the commodity complex and the dollar, it was a very clear relationship. As crude was selling off right there, as gold was selling off right here, you had the dollar rally, no problem. Dollar sells off, gold rallies a bit, crude oil continues. All that crude did was just go sideways before moving lower, which gave the dollar another boost. So here we are now. Gold's starting to kind of go sideways. Dollar starting to go sideways while crude oil continues to go lower. So is that just a product of the market getting quiet ahead of the holiday? Probably. We're starting to see sloppy action in the FX market. But as I said, what's not getting sloppy is the bond market moving higher in the last couple days. Stocks continue to stay strong. We are below a key fib and Elliott Wave level in the S&P that we'll talk about. So intermarket picture, I have lost a little bit of conviction in terms of the clarity. It's getting a little bit more muddied than it's been over the last couple of weeks. From the last couple of weeks, it's been just a beautiful intermarket relationship. Okay, so from there, let's get into some of those markets that I just mentioned. We are long with clients. We are long the bond market, and that is via a TLT call spread. So TLT is the bond ETF, and we have a very small position going there in the bond market. So TLT, we have a December 120, 125 long call spread. It's at $1.26. When I checked, it was trading at about $1.30 or something. So we're up real small on it. The trade has taken so long to materialize there. We're up just a small amount of money from time decay, from theta. So that's fine. Whatever. It's not been a huge trade one way or the other. Pretty much a break-even trade, but we're starting to get a little bit of action here. So, this is a long-term uptrend. If we move over to the daily chart, you can see that this guy has been rallying since September 2013. Not really sure what the wave count is, but we saw the massive spike up on October 15th, and the market has sold down into the 618 retracement. So I'm looking at a wave 3 or C move higher. We don't know what it is at this point, but what you always do is look for the equality point of C and A. And what I mean by that is you look for the point that the distance traveled in this A wave is equal to the distance traveled in the next rally wave. All right, and that is going to be right here at that green 100%. The 618 level, 618, the distance of the prior trend wave is here at about 147, and equality is up at 153. So those are the levels we're going to be looking for on the way up. That's C versus A. I also have C versus B. Okay, so rather than doing a relationship of A wave compared to C wave, we can also do a relationship of B wave compared to C wave. 100% is obviously a test of the old high, and then 1.618 is up here at 153, which matches up with equality. All right, so those of you not trading bond futures and actually trading the stock TLT, you can just overlay TLT on top of it to get a rough approximation of what the stock price will be. So just going to throw TLT up there, create, I'll let the data come in, and then we'll just have to kind of best fit the data on top of the bond market. Okay, so I'm just using my scrolling feature here on MotiveWave, which if you just left mouse click and hold the left scale, this guy will move. And then there's another cool feature. I don't know what you call it, but if you left click, you can kind of scale just the top half of the chart. Very cool feature. I've actually never seen it in another charting package. So there, I've fit TLT over the 30-year bond price, and you can see on the left scale, I'm trading about 121.5 in the TLT. The equivalent level will be about 126, and up here it'd be about 131. So if we want to press these trades, if we think there's more room to go, we can continue to do long call spreads, which would be like buy 121s, sell 126s, just to see if we can capture the move up to this first cluster of fib support. Or if you want to get a little bit more bullish, buy yourself more time, not just December, but go out several months, you could do something up here into the 130s, like a 120, 130 long call spread over the next 3 or 4 months. Okay, so it just depends on what time frame you want to trade, but we have upside fib objectives from both A wave versus C wave as well as B wave versus C wave. And the reason I opened with that intermarket analysis is just because bond markets are rallying does not mean stocks have to sell off. Okay, remember, bond markets going higher means interest rates going lower. Lower interest rates are what the Fed has been trying to engineer, and other central banks around the world are trying to engineer. Lower interest rates equates to more borrowing, spending, investment, etc., etc. Okay, so that's bonds. Stock indexes have gone very quiet, and let me just pull this over here, get everything on the screen. Stock indexes have gone quiet. SPX, the S&P is up at 2073.72, which was a key external fib retracement. We traded it. We've backed off. We're trading at 2067. We have 30 minutes to go until this market opens. So I'll just let this price data come in. And what I mean is this. So if you look at the decline from September 18th down to October 15th, we went past the 100% retracement, which is the old high, and we've moved up to the 1272. This is actually calculating at 2076. So that's interesting. Okay, so it's 2076. I was off by 2 points. So that's the 127% external retracement. And that's a secret that a lot of people are not familiar with. They don't know how it's calculated. And I'll tell you right here how you do that. Okay. The two levels that people aren't aware of where they come from, the 786 and the 1272. Okay, the 786 is related to the 618 by square roots. Okay, so square roots are important, and I don't want to get too far off, but those of you who are curious, I'll show you how we calculate that. Okay, so 618 is the fib ratio that we all know, right? 0.61.8. And if you just do a square root, you get 786. Okay, so if you just actually do this 0.618, and you just do a square root, 0.786. So anytime the market doesn't hold the 618 retracement, it usually goes up to the 786. Okay, And then also related to 1.618, which is the other very common Fibonacci ratio that we all know. 1.618, if you do a square root, you get down to 1.272. So the square roots are very important, 6786 and 1272. So along with 61% and 161%, use their square roots. Okay, those levels come into play. Generally what happens, guys, is a market that gets through the 78%, goes through the 100%, and goes up to the 1272. And that's exactly what's happened here in the S&P. So this has been a target of ours for a long period of time, which we did actually, we actually just fell about a point short of. So the whole idea here, guys, is the S&P is into resistance. We can count a 5-wave move. It's its pullbacks and its corrections are quite how do I say this, undefined, because it's been just such a sharp one-way rally. It's actually a difficult wave to count because there are no clear corrections like there have been in the prior swing. So you gotta have to rely a little bit more on fib than you do in wave analysis here. So we have tested this ever since November 21st, and here we are November 25th. We still haven't decided what to do up at the 1272. Okay, if you go to the NASDAQ is through the 1272. NASDAQ's been stronger than the S&P. Okay, the NASDAQ's looking to get up to the 1.618. So as soon as the data comes in here, I will show you what we're talking about. There we go. So here is the 1272 in the NASDAQ of the September 19th, October 15th. We got through it. This is the NDX, the NASDAQ 100 at 4240. We hung out for a couple days and then eventually broke through. You've got some pretty strong stocks. You've got Apple breaking out. You've got Intel. We actually just went long Intel yesterday with an option spread. You've got some pretty good performance here in tech stocks. Okay, so we got Intel. We just did a long call vertical in January, 35.40 long call vertical. Paid $1.86 for it. Okay, so NASDAQ's looking pretty strong. And I also want to talk about some sector stuff. We're starting to see some sectors in the stock market begin to outperform, and these sectors I'm going to talk about are good for a continued rally in the stock market. We're seeing more offensive markets, sectors rally. Previously, we're seeing more defensive sectors rally. So just in the last week, we're starting to see consumer cyclicals in technology, in financials, in transports begin to pick up. Those are all sectors that are very good for stock market rallies. Previously, we're seeing consumer staples, and we're seeing healthcare, and we're seeing big dividend payers, defensive sectors pushing the market higher. That was a cause for concern, and that has now changed. Okay, so let me show you what I'm referring to. So back to our intermarket analysis workspace here, let's take a look at the sector overlays. Okay, this is a percent change chart. Come on, baby. From September 15th, and that was, or September 19th, that was the stock market high. Okay, and I've got these guys labeled here, and if I stretch them out a little bit, it looks like we're trying to pull this data in. Utilities. This is one of the sectors I just mentioned. The white line is utilities, and this guy was very, very strong. Okay, utilities are dividend paying. They typically trade counter to the stock market. Utilities receive flows when markets want to get a little bit defensive. Okay, it's not a growth sector. So utilities were strong, but have since begun to back off, which is really good. In there as well is the consumer staples, which are your XLPs, which must be, let me just find my staples. Oh, it's going to be, oh, that guy wants to freeze on me. Hold on. Come on, baby. Where are my staples? XLP must be buried in here. Yeah. XLP must be buried. But one of the sectors that has begun to pick up on the top side right here is the XLY. And that is your consumer discretionary. That guy's begun to move higher quite well. And I've been on CNBC 3-4 times in the last week talking about that. The purple line are the more aggressive stocks that do better in higher, improving economies. You have like Disney and Amazon and Comcast. Those are some of your big players in the XLY. Okay, so the XLY has begun to pick up, which is very good. XLF has as well. The financials have begun to move higher, which is good. Okay, submarine here is my staples, consumer staples, which is beginning to decline. Looks like I'm getting trade stations giving me a hard time there with the data. Okay, over to the 5-minute chart, we can get a better view. There it is right there. Oops, looks like this guy's struggling too. But the XLP, that's the ETF I was looking for in kind of that off green color. The XLP is your consumer staple ETF, and that guy has begun to level out, which is good. Compare that to the XLY, which is beginning to move higher. That guy is your discretionary. That's the one you want to see rallying with a higher stock market. We're starting to get it. Okay. Also XLK, technology. Technology's begun to move up. That's the NASDAQ. All right, so that's good. So we're seeing better sector participation on the top side, and that's why we're starting to move more towards the bullish side of the stock market. Okay. Also, another play that we've put on is Lennar, a home builder. Home builders are breaking out. And the reason home builders are breaking out is part of this rally that we're seeing in the bond market. Okay. We go back to that 30-year bond. Bonds move higher. This is a key relationship that you guys need to understand is if bonds are moving higher, guys, interest rates are moving lower, right? And interest rates moving lower. Let me just get my drawing tool out here. Okay, drawing, there we go. Color, let's get a good color people will watch. How about green? Okay, so as the price of the bond market goes higher, so as bonds go higher, bond yields, which is also called interest rates, move lower. So as bonds go up, the bond yields are going down, interest rates. And as interest rates go down, that generally pushes money into housing, right? Housing stocks, related housing sectors tend to do well. Home Depot is doing well. Lowe's is doing well because people like to invest in housing with low interest rates. So if you continue to see a move higher in bond prices, interest rates move lower, housing should do well. Okay, and that's what we're seeing on the market, on the charts of some of these housing sectors. Okay, Lennar, we got involved yesterday, and we'll let this price data come in. Lennar acting very strong top side. Toll Brothers acting very strong on the top side. So here's the daily of Lennar. I'll show you the longer term wave count. Let me just pull him in. Just see if I can stretch out and get a full screen there. There we go. So, oops, come on back. I'm on log scale. Semi-log off. There we go. Okay. So from March 2009, I'm looking at wave 2 correction down to 2011. Nice breakout in wave 3 up to May 2013. And then we've just done triangle A, B, C, D, E down in wave 4 to October 2014. So it looks like we are in a 5th wave rally inside of Lennar. So each of your trend waves, one decompose as a leading diagonal. Probably do it like that. Each of your trend waves, 1, 3, and 5, all have 5 smaller waves. And that's going to give me an error because it's actually not a diagonal, so that's fine. I'll change that. But that's 5 waves. And then inside of wave 3, we have 5 waves. And now inside of wave 5, we need 5 smaller waves. Okay, so this is on the daily. So we're looking inside of green 5, we need orange 5 orange waves. So far, we're looking at orange 1, orange 2, orange 3, and we have further to go. So from the daily, we look to be inside of orange 3, so we want to keep going to smaller time frames that match your risk profile. Okay, your risk profile is going to determine how large of a stop loss, how large your position size on the trade. It's all dependent on time frames, and that's what's great about Elliott is you can match your risk profile according to the time frame. The larger the time frame you trade, the greater the risk you're going to have to take. So we like to trade around the 3-hour time frame. Okay, we're going to have to risk a couple dollars, meaning 47 down to 45, 44 on this trade. So we're risking $2 in order to make $4, $5, or $6 on the trade. We do it in options. That is our sweet spot at Trading Analysis. Okay, so inside of orange 3, as we discussed, we should have 5 smaller waves. So far, we're looking at this as 1, 2, and we're thinking this might be a wave 3 breakout. Okay, and this breakout should hold because we've broken old resistance back from Feb, back from October 28th, and it's now serving as support. So if this breakout's for real, we should really not get back below the $45 level before we start moving up to 50, 51, and 52. So that's Lennar. The option trade that we did was the, what do we do? The 45.50 long call vertical in January. I got to put a J in there. January 45.50, we paid $2.32. And if I go right here, go to the setup chart, you're going to see the exact same chart that I'm showing you right now. Okay, you guys in MotiveWave webinar get the extra special behind the scenes at Trading Analysis because we love MotiveWave. So we did the 45. So we bought the 45 calls right there, and we sold the 50s. Okay, it's a $5 wide spread. I do think we're going to go up into the higher 50s, but that's going to be months and months down the road. So we'll take this trade in 2 steps. If we can get the 45.50 move, we'll then kind of hang out in wave 4 and look to grab the final 5th wave move up, maybe in a 50-55 call spread. But that should take us through, at that rate of ascent, we could get the move into January, but we'll probably have some consolidation in here that takes us out into January, February. So it's probably better to take it in 2 steps. Okay, so that's Lennar. Intel is another stock we're looking at, and Intel is looking strong on the top side. We did the another long call vertical there in Intel. I showed you that technology is acting very strong here, guys, and that's a great sign for the broader markets. We have a nice 5-wave move up, 1, 2 down to February. Beautiful wave 3 breakout, 1, 2, couple continuation gaps in there inside of wave 3, which is what you want to see. Pull back in 4, move up in 5, and then here was your decline down in wave 4. And now we look to be moving higher in a wave 3 of a higher degree 5th wave. Okay, so if this breakout is for real, again, we shouldn't get back below this high, which is 35.65. We have a long call vertical going on. And the way you structure that is in this 3rd wave, you're looking for this guy to travel at least as long as the distance as the distance traveled in wave 1. So you got ratio analysis 3v1. Equality is right there. So that's your minimum target. That's at 38.45. Ideally, we should get up to the 1.618, and let me get these time studies out of the way. And we should get up to the 1.618 because that is our green color-coded level for wave 3. Typically, wave 3 goes 161% times the distance of wave 1. So we have a minimum target here of 38.5 and an ideal target of 42.27. Okay, so we took it a bit more conservatively again. And let me just get back to the trade desk here, which is going to be right there. Stock trade desk, new tab. Just show you the trade we did in Intel. We did a January 35.40 call spread, paid $1.86 for it. And this is, again, conservative. We did a 35.40. Okay, you might say, well, what about 42? The wider the spread you do, guys, the more risk you're going to take. So I'm not looking to capture all of this 3rd wave. We're looking to capture the middle meat of it, 35 to 40 in this zone right here. So we're long the 35 call, short the 40s. That's the meat of the move for a 3rd wave. So if that's the case, we shouldn't get back below this 35 level. Really shouldn't break back below this breakout level, and it should carry us up into the 40 level into end of the year. Okay, so that's kind of a rundown of what we're looking at here, guys. The point that I'm trying to make is this is a very sector-driven market. The S&Ps haven't done anything. Nasdaq's acting a little stronger. Russell has been acting, the small caps have been acting feisty lately, which is good. Not quite catching up to where the S&P and the Nasdaq are, but you're starting to get small caps back in the mix, and that is good. So, the count we're looking at here is I'm not so sure on the Russell. I didn't really talk about it. I don't love this wave count. If those guys are going to continue higher, this can't be a fourth wave moving higher in wave 5. This is probably going to be maybe a second wave, which I don't know. Russell's a little dicey. I don't have a high degree of confidence there. But the point is, this is a sector-driven market, right? You want to be in strong stocks and strong sectors. You want to be short weak stocks and weak sectors, because there are sectors moving around. The broader indexes aren't doing a whole heck of a lot. Okay, so that's the stock market land. We did the bond market. Gold has gone quiet into 1200. I would like to be short gold into 1210 to 1220. We have a couple of different wave counts possible here in the gold market. The move higher in gold, this is a level that we've talked about quite a bit, around the 1140 level, has held, and we've seen a 5-wave move up. It's not been that impressive. I was expecting a sharper move higher in gold, and it can be counted in 5 waves, but like I said, it's less than impressive. So this is probably some kind of triangle fourth. So it's going to be A, B, C, D, E, and triangle 4. One more little push up. This is a pretty good sell zone in gold. And I have 2 wave counts, guys, in gold. Both project resistance into 1220. Both project a pullback towards like 1160. So this one says we have one more move up, followed by a 3-wave pushback down. Okay, that's the primary. The alternate count says this is an A wave, and we have a B wave decline. Okay, so we have resistance in 1220 back down to 1160. Don't know what the wave count is, but we have 2 correct wave counts that foretell resistance just a bit higher and for a push lower. So I like that. Crude oil continues to get crushed. We have an OPEC meeting coming up where Saudi Arabia is talking about cutting supplies. I gotta tell you, I don't know what the wave count is. I should probably have just do the auto analyze. In fact, let me just do that. I don't know what the wave count is. This isn't a clear downtrend, but it's just sloppy. All right, so in order to use MotiveWave's auto analyze, I'm just going to right click, decompose 2 levels, and it already does. I already have them decomposed. I have them hidden, but I'm going to have MotiveWave replace them. Yes. Okay, and let's just take a look. We have a little overlap between 4 and 1 in the 3rd wave position. Sometimes you got to give the scanner a little help. Now, one of the rules that you want to make sure is in a good wave count, you don't want overlap in the strongest waves, which should be the 1/3 of a 1/3, and that's the breakdown. Okay, so not bad, not bad, not bad. Don't know what the wave count is, but there is a pretty good downtrend in play. So let me just put a channel over it, and when I don't have a good wave count, I just like to stay inside of the channel. So we are at the 1.618 relationship of wave 1 versus 3. So we've met the downside objective. Okay, so it's possible we're in a 4th wave. We could be, I don't know. Don't have a high degree of confidence here in this crude oil count. But what we can look at is on the crude oil chart over on the daily, we're just breaking support after support after support. So I have 3 shown here. I've got the lows from January 10th, got the lows from April 17th, we've got the lows from June 28th, 2012, all broken. Okay, all have been broken. So we got to get out to the weekly chart, and look for the next downside support. The next one is down around $64 from February 2009, the low of the credit crisis. So, this guy is really on the move. So I'm thinking we want to get down to test the $64, $65 level. The structure of the wave count is a little messy, but you know, it is what it is. So markets aren't always going to unfold in beautiful wave structures. Okay. So from crude oil, actually, guys, just give me 1 second if you don't mind. And if there's markets you want me to take a look at, please let me know. I just got to upload one thing. Not there yet. Guys, I need about 30 seconds. Seconds. Doing the MotiveWave webinar. Okay, guys, sorry about that. Okay, so that's that. We did crude. The dollar has begun to break down a little bit, and we were looking for a fifth wave move in the dollar. And it's beginning to get a little tired. Okay, so here's what I'm looking at in the dollar. From May 14th, we're looking at 1, 2, a nice breakout in wave 3, pull back in 4, and then a move up in 5. All right, so just a hotkey. Tony MotiveWave has given us the hotkeys for wave 5. All you have to do is click on the label you want to do, and on my keyboard, I'm hitting Alt 5. Alt 5, you right click, you pin. Alt 5, you right click, pin. Alt 5, right click, oops, pin. Alt 5. So what you're looking for is a cluster of fib resistance. You can get rid of the outliers. You can just right click on and remove them. And you're looking for a cluster. So there's a pretty good cluster down here, which didn't hold. And there's a pretty good cluster right here that's held. Okay, so I'm just going to remove the lower cluster and say, okay, guys, it looks like we have a zone of resistance in the dollar, which is now holding. And inside of wave 5, you want to be able to count 5 smaller waves, right? So if we do 1, 2, I mean, I can see it right now, and I'm sure you can as well. Let me get over to the 3-hour chart. Into wave 5, can you count 5 smaller waves? Sure, but let's let MotiveWave do it. Right click, decompose as an impulse. I'm going to decompose 2 levels. Oh, that didn't work. Control Z. Let me line him up and try it one more time. Decompose 2 levels. Yes. Okay. There we go. So yep, we're doing 1, 2. We're doing 3, 4, and then up in 5. So that's cool. It actually looks like a triangle. So we have 5 waves up inside of 5, inside of fib resistance on the higher degree daily. So we are long the dollar right now, but we have stops at break even in our FX service. We have been trading the long side of the dollar the whole way up, but we are very much wondering if it's about over. Okay, we're obviously using crude, we're using gold to help us navigate where the dollar goes. You know, it looks like we have another push up in gold. I mean, this thing could grow some legs and start to get a little bit more dynamic off the lows. And if gold really begins to rally through 1220, then that could really help to put in a top in the dollar. Okay. Now, what's interesting is the dollar has been rallying in the same direction as the stock market. So if the dollar were to sell off, that could begin to hurt the stock market. So just keep an eye on that. All right, so I mean that's kind of a trip around the world, guys. You know, watch the bond market. That's important. Bonds can rally with stocks. Doesn't have to happen. You know, it's an inconsistent relationship, but it's important to keep an eye on. If this bond market really starts to move higher, if the dollar stops rallying, you know, watch what happens to stocks. Okay, things are gonna get quiet here in the holiday. It's now snowing here. Anybody else have it snowing? Let's see if I can turn the camera around. It's now snowing. Boo. I hope you guys all have a merry, happy Thanksgiving, and stay safe. So I'm gonna stop the recording here, guys. If you have any questions,